How to Invest in Stocks for Beginners 2020. We are currently in the midst of a historic stock market crash, potentially the worst since the Great Depression. But don't let that scare you. In my opinion, times like these are the best opportunities to get started with investing. You will be able to see and experience a stock market crash firsthand and really understand if investing in stocks is the right choice for you. If you can make it through times like these as an investor, you will be able to make it through just about anything. And with stocks trading at discounts, you may be able to set yourself up for a very profitable future. But first off, what actually is a stock? With all the numbers, charts, and financial jargon, investing in stocks can seem a little daunting. But at its core, the stock market is simple to understand. Stocks represent part ownership of a company. When you buy a share of stock, you are literally purchasing a piece of a company. For example, if you purchase 10 shares of Facebook at $150, you now own $1,500 worth of Facebook's business. Facebook is currently valued around $450 billion, so you only own a tiny fraction of it, but you are still an owner and shareholder all the same. So why should you invest in stocks? Every day your money loses value to inflation. So you have to invest in something, and in my opinion, the stock market is the most efficient way for you to grow your wealth over time, meaning it offers the highest reward for the lowest effort. Unlike most other investments like real estate or starting your own business, stocks can make you money without you really having to do anything, and with very little money up front. You can get started investing in stocks with as little as a few $100s, or even less if you have access to commission-free brokers. On to the most important question: how do stocks make you money? There are two basic ways to make money in stocks. The first is that the value of the company you purchase goes up, and you sell it at a higher price. For example, if you purchased Facebook at $150, then later sold it at $200, you would make $50 in profit. This is called capital gains. The other way you can make money in stocks is through dividends. Dividends are small cash payments that many companies pay out to shareholders, usually every 3 months. Not all companies pay dividends, and they are free to change the amounts they pay or stop paying dividends entirely if they want to. However, some companies are very committed to their dividends and continue to pay out bigger and bigger dividends every year. These are companies that I myself like to own for their consistent passive cash flow. One thing you do need to keep in mind is that stocks will not make you rich overnight. In fact, they probably won't make you rich after a year or even several years. Many people get into stocks in the hopes of making a lot of money in a very short period of time. You need to keep your expectations realistic and understand that the vast majority of people who attempt to trade in and out of stocks on a short-term basis lose money. For most people, and especially if you are new to investing, being a long-term investor is the only consistent way to make money over time. Is investing in stocks the right choice for you? Like I said, if you're investing in stocks, you should plan to be invested for the long term, a few years at minimum and preferably 5+ years. This is because the stock market tends to be irrational in the short term. Prices will go up and down, and it's very difficult to time the market. Buy low, sell high sounds simple enough, but on a short-term basis, almost nobody can do it consistently. So you should not be investing any money that you are not willing to lose or that you will need for any expenses in the short term. In order to invest in stocks, you need to be able to handle risk and volatility, or short-term price fluctuations. When you first buy a stock, the chances of it going up or down in price immediately after you purchase it are 50-50. But if you buy solid businesses that grow their profits over time, the chance of you making money over time are much higher. Another thing to consider is your current debt situation. If you're currently carrying any high interest debt, really anything with an interest rate over 5%, you should probably pay that off first. If you're carrying any really high interest debt like credit cards, you absolutely need to pay that off before you start investing. Carrying debt with a 20% interest rate is like guaranteeing yourself a negative 20% return, and you are overwhelmingly likely to lose a lot more money paying that interest than you will make investing in stocks. Now, if you've decided to try investing in stocks, there are two basic routes you can take. You can either purchase shares of individual companies like Facebook and Microsoft, or you can buy an index fund like the S&P 500, which is made up of the 500 largest companies in the US. Buying an index fund is like buying the whole stock market. If the economy does well generally, you will make money, and if the economy isn't doing so hot, you will probably lose money. If you're not really interested in researching individual companies and just want the simplest and easiest way to benefit from the stock market, I would recommend taking this route. But if you are like me and are willing to put in the work, if you want higher rewards and can stomach higher risk, then you should consider picking individual stocks. Buying an index will give you the average return of many companies. So if some of them do really well and some of them go bankrupt, you won't benefit that much from the ones that do well, and you won't be hurt too much by the ones that go bankrupt. Buying individual stocks means that if you pick the right companies, you can make much more money than if you had just purchased the whole stock market. But it also means that if you pick the wrong companies, you can stand to lose a lot more money. When buying individual stocks, I would recommend starting with companies that you are already familiar with, companies whose products or services you use and understand. You will also need to learn how to value companies, how to pick companies that will continue to grow into the future, and how to figure out how safe a company is. This will involve looking over financial statements, reading balance sheets, etc., and it will be somewhat of a learning curve if you are completely new to investing. Now let's talk about risk and reward. What can you actually expect when you're invested in the stock market? Well, the worst case scenario when you buy a stock is that you lose 100% of the money you invested. In other words, the company goes bankrupt. The best case scenario is theoretically infinite if the company can continue to grow indefinitely and their share price grows as well. Realistically, though, if you were to purchase an index fund, you would be able to achieve returns somewhere in the range of 7 to 11% per year on average. There will be years where you make a lot more and years where you lose money, but average historical returns are in that range. If you choose to purchase individual stocks, it is possible to make a lot more, as much as 15 to 20% per year if you are really good at it. However, as I mentioned, you also stand to lose a lot more if you choose the wrong companies. So how do you actually buy stocks? Well, first you need to set up a brokerage account. This is basically an account that you will open with a financial institution where you can hold your stocks. There are many different brokers out there. If you live in Canada like me, I would recommend Questrade or Wealthsimple, as they have the lowest brokerage fees currently on the market. If you live in the US or another country that has access to commission-free brokers, there are tons of options to choose from, like Robinhood, TD Ameritrade, and many others. One thing you should keep in mind is that if you go with a bigger, more well-established institution like a bank, you will probably get better security and better customer service than if you go with an online app startup like Robinhood. This was demonstrated pretty well with Robinhood's recent server crashes on high-volume days in the stock market. Now, once you've selected an institution, you will need to decide what kind of account you want to set up, namely a tax-advantaged account or a regular account. If you live in Canada, I would highly recommend setting up a TFSA, or a tax-free savings account, so that you can grow your money tax-free. In regular taxed accounts, you will be taxed on any gains you make and any dividends you receive, but in most cases, these tax rates will be less or equivalent to what you would be taxed on your regular income. Thanks for watching. Don't forget to like, comment, and subscribe if you enjoyed this video and want to see similar content in the future. if you have any questions about any of the information that I went over in this video, feel free to leave that in the comment section. I hope you all have a great day, and I will see you in the next video.